Next guest predicted $100 oil before tensions erupted in Egypt. Jason Schenker, president of Prestige Economics, is a Bloomberg best oil forecaster, and he's back with us this morning to explain what the chaos in North Africa holds for crude prices in 2011. So, Jason, does this change your outlook? Are you more bullish on oil prices as a result of what we're seeing in Egypt?
Well, not really. And the reason is when we were talking about where oil prices are going, right now we see something that's really crazy, which is that Brent prices have been moved sharply higher, but WTI prices are actually still somewhat depressed. If we look at our forecasts, we had actually recently revised them up. For WTI, we now see $95 a barrel this year for the average, and for Brent, we see $98. And that makes sense from where we are and the fact that prices are likely to ease a little bit once these tensions cool off slightly. Okay,
well, that's a very important point, and I want to make clear to everybody what you're talking about, WTI being the benchmark for U.S. oil and Brent being the benchmark for international oil. Why is it, though, that you anticipate these tensions ratcheting down? I guess you have to make a macro call, right?
Well, yeah, there is a macro call, and if we look at what affects oil prices, in terms of supply lines, Suezmax is not one of the biggest tankers out there. The ultra-large crude carriers, the very large crude carriers, those don't fit in the Suez Canal. Even if there were to be a bigger disruption in Egypt that would disrupt the Suez Canal, it would not disrupt the largest quantities of crude that are going to be waterborne. At the same time,
can I just interrupt for a second, because I think people need to understand the point that you're making there. What is it, about 2.5% of the world's oil supply that flows through the Suez? Is the point that you're effectively making that the supply-demand balance isn't so stretched right now that the loss of even 2.5% would matter that much?
Well, the truth is that there wouldn't actually be a loss. The oil would just go elsewhere, right? Even though there's a problem right now in terms of social disruption in a given region, this isn't going to knock the entire global recovery or the global economic growth story for the next few years off the tracks. That train is going, and it's going to need oil, and that situation has not changed.
So is it fair to say at this point, based on what you've just told us, that maybe oil markets are overreacting to the situation in Egypt?
Well, I think that's very true. I think that can happen always with commodity markets, that there is always an increased amount of risk that gets priced in to that total price of oil, but that can come off a little bit. But always at first, when there seems to be new information in the market, when there seems to be new threats, it gets overly priced into the market because people don't want to get caught short. It's new information, and people either want out of the market, which means they have to cover their shorts, which drives up price, or they take a long position, and those things push the price of crude up, and that's what's been going on.
Jason, what would you need to see to change your view? Which countries would have to get involved for things to really begin to spiral out of control and for you to think that maybe oil has nowhere to head but higher?
Well, I think if this were to spill over into one or two OPEC member countries, we might have something different to talk about. But I think even if that were to occur, at the end of the day, regardless of what regime would be in control of any given country, they want to continue to make money. And exporting oil, the demand for oil is very high, prices are very high. Any country where there's even going to be some social unrest, who's in control of that country might come into question, but those supplies will still get to market.
And maybe good illustrations of that would be what we've seen happen in Iraq and Iran. Oil continues to flow to those countries despite all the trouble that they've been contending with.
That's right. That's right. And those supplies, they're coming to market. And again, even if you were to you're not going to disrupt the production side. You're not going to disrupt the demand side. And from the supply side, yes, the Suezmax tankers that go through the Suez Canal could be disrupted. But it's not that they're going to sit there and that oil will go unused. It will just go to different destinations where you still have high demand. Oil is very fungible, and you're going to see that oil will still get to market. It's not that the oil disappears.
Oh, Jason, thanks so much for joining us this morning. Jason Schenker of Prestige Economics with some key points. Number one, the markets are overreacting. Number two, $100 oil is still going to be with us.